What's going on, everybody? Welcome back to the Fishhook Trader. James Nash here. Today we're going to go over debit spreads. Is it the safer option? So what we're going to do here, let me pull this up just a little bit, maybe not so much zooming. You won't be able to see my body much, but it's all good. All right, so debit spreads. What is a debit spread? A debit spread is where we buy an in the money or at the money call and put, and then sell simultaneously, same expiration, an out of the money or at the money call or put, depending on which one. So it's going to be the same, call and call or put and put. It's called a put debit spread or a call debit spread, however you want to say it. So, question of the day: is it the safer option? Potentially, yes. So what you're going to look for is the breakdown first is, why would I open a debit spread? Well, I'm directional. I think it's going to go up or down or stay in a slight incline or a slight decline over X amount of time. Staying straight across is not necessarily a bad thing. You could, in theory, still make money on this position, but you would not realize the max profit. I got an alarm there. You would not realize the max profit. So how do we realize the max profit? How do we know what the max profit is? Well, we're going to do it like this. So we'll say that GE's had a good day these last few days. GE is at $10, right? We think GE's going to continue doing this. We think it's potentially could go back to $12 a share. So we're going to think $12 a share, right? So the cost of this spread is going to be $200. Why is it $200? The difference between your strike prices. I just woke up, sorry if I look tired. The difference between your strike prices is $2, right? In option world, this is $200 because we multiplied by 100 to get the $200. So 2 times 100, so 100 shares per contract. So each contract is $2, so it represents $200. All right, so what we're looking at, that's the difference in strike. All right, so now we see, okay, so I can make $200 on this trade. Potentially, that's the max profit, right? But do we really make a full 200 on a debit spread? Because the debit spread is meant to do one primary thing: lower your risk while simultaneously capping your profit, hence the lowered risk. So with that being said, so we got 10 to 12, we think the price is going to go in this range. So we're going to buy one call at, we'll keep it simple, $10. All right, so we're buying the $10 strike call, right? Marker's crapping out on me here. Hope you guys can kind of see this. It keeps zooming in and out. Really sorry about that. So buy one call at $10. We're going to say this is going to cost us, we'll say $100. We'll say it's going to cost us $100. Maybe go into the crew here and see if we got a better one. All right, buy one call at $10. That's going to be a $1 cost, so $100 cost up front. Now we're going to simultaneously sell one call at $12 because we do potentially think the price could go to $12. All right, now say that one costs us $50, all right, which is $50. All right, so now we have a buy-in at $100 minus, you're subtracting the sold call, because instead of selling a call naked, you know, where it's going to give you a credit and you're selling it, you have to have the amount of money to be able to sell 100 shares at $12, right? And so chances are, you know, a lot of people don't have that when they're doing options. They're just simply buying and selling contracts, which is what the majority of options traders do. Not all of them. Plenty of them hedge, like I said in that last video. So you're going to sell the $12, so you're going to take the 100, you're going to subtract the 50, all right? So obviously your leftover is $50. So your all-out cost on this is going to be $50, right? So how do we make 200? Well, 200 would be realized in the event that the stock price closes over 12, okay? My son, excuse me. What's up, big man? Anyway, So hopefully this video doesn't get ruined. What's up, man? Dad's making a video. What's up? You being good? Yeah, we got to go get Han very soon. I love you. Video time? Sorry, guys. So we want the price to realize $12, okay? So that's going to move up this full potential here of $200, all right, minus what we paid. That's your $50. So you subtract that. Now the clear difference is $150, all right? So $150 is your total realized profit. So how do we know what expiration we're going to do? What expiration we're going to do? Well, we're going to go, because we think this could happen in maybe the next 3 weeks or a month, because the price action is going nice and incline over here. So we're thinking 2 months, 3 months time frame. So we're going to go out a minimum of January as of right now. This is November 3rd or 5th or whatever it is. We're going to go out to January 17, right? We're going to sell. Now, I don't know, these are actual option prices on that. This is just an example. Again, nothing in the video is trading advice. I may potentially do this, but I need to see further price confirmation, because GE and Ford used to be my favorites back in the day to trade. And GE and Ford both had these ranges that they bounced off of all the time. And $12 is one for both of them, actually. More or less, Ford is around 11, 11.20. But the bottom dollar on GE is around 7. So is Ford. Both of these companies have been around for a really long time. And it's just nice to see, you know, very common practices. Ford still pays a moderate dividend. So we just have to see what we can really come up with there. But anyway, so debit spread. Your total max gain is capped, all right? So say you just bought the $12 call, say you bought enough, say instead of spending the 100 on this and subtracting the 50, you just bought 2 calls at 100 straight up, and they realize in profit at $12. Well, the chances are your profit on those, because of the delta, I didn't say delta and theta at the same time, the delta is going to be pretty moderate on these $12 calls, so probably between 0.40 and 0.80 or possibly even 0.90 per dollar increase. So you're looking at a $2 increase from 10 to 12, and then you're looking at realizing 2 contracts. All right, so your cost was 100. All right, so you're looking at easily $100 roughly per dollar increase. So your max profit here could be between, you know, the 100 you invested, so maybe 250 profit to potentially 300 or 400 on a nice implied volatility spike of the premium. And that doesn't happen very often because these things move so slowly. But that moment the price spikes and breaks 12, say 12.15, you best be ready to sell these or have a limit sale at whatever price you already have built in. Because if you don't, chances are you're going to miss it. All right. So we will. Let's have another example here of why you would buy a debit spread. All right, got my little helper out here. You see the little hand. All right, so why would we buy a debit spread? Well, let me be frank with you. So Shopify, one of our favorite stocks to trade, especially options on because of its massive $5, $10, $20 swings. I was right, by the way. It went back to 300. It hit like 295 today. So say shop's going down, we want to do a put spread. All right. Well, first of all, we're thinking puts anyway because it's going to continue down. I think we could probably see 290, potentially 285 again. I'll have to look at the chart and find out where the 200 EMA is. But what we're looking at is we know that we want to be in puts. Now, here's the thing. A put is going to realize faster money by itself with the price continuing to decline. Otherwise, a debit spread will also realize profit, but the price needs to stay in this range. So with Shopify or other things that move drastically like Roku, you're going to want to be paying attention to this debit spread. Chances are it's not going to be in the range that you want it to be in for your expiration because Shopify moves so much. It could be 280 today or tomorrow, and then next week it'll be back at 315. Okay, and you will lose money on a debit spread, whether it's put or calls. If the price moves against you, you will lose money. It's an option. It is a decaying asset. All right, it is a depreciating asset. So what we're going to do is a put debit spread, right? So we want to go in here. Let's just talk about the cost of some of these options. let's just be real. Some of these shop premiums are like $1,000, right? So $10 is $1,000 on an option premium. And you're looking at $1,000 for one at the money, say $290, right? Well, I think it's $295, so we'll say $295. So right now we'll say the price is still at $295, and we buy that one in the money call. That's going to cost us $1,000, right? A lot of people don't have $1,000, not to put on one trade anyway, because if it goes against them, especially at the money or in the money, it's going to decrease very rapidly with theta and or implied volatility. So with that being said, we got to be careful of what we're actually doing. So you want to carefully pick these. Now I have a kind of a process I've started using, because I've used this and I've had the account double what I started at, and and I slept through it that day I talked about in the other video with Tesla, and the account was at 800 something. The very next day, that same strangle actually was, the debit spreads made the money, but the strangle I'd set up, which is also a type of spread, actually was about $1,500 in value the next day. But I'd already sold it because I was thinking it was going to have a good sell-off, which it did, but it happened a little later than I expected. So, $1,000 at the money, we'll say at the money, not in the money, because I don't know what the price is right now. And say we want to buy this one. We're buying this put. Oh, bull. Golly. Y'all can tell I'm tired, man. I'm writing sloppy over here. So we're going to buy one put, all right, at $1,000, okay? Now we're going to sell, we think it's going to go to $290. And you will realize profit the most at a few different scenarios, which I'll explain in a moment. So we're going to sell, let's see, at $290, all right, put, which is, it's pretty much still at the money because shop moves so much. I wouldn't call that out of the money, so we'll still say at the money. And that's going to cost us $800, right? Well, it's going to cost whoever we're selling it to $800. So what's going to happen is we're going to take the $1,000 that we're paying and then subtract the $800. All right, so here we go again. You're paying $200, period, to be in a scenario that puts you at the money. All right. This doesn't happen when you're buying puts and calls and at something like this, like Shopify, unless you have the capital to do so. Most people don't. A lot of the people in the chat groups are very small accounts, starting off $20, $50, $100. Some are 3 or 5, some put 5 or 10 grand. But it is all what you're willing to lose, obviously. So your cost is going to look at $200. But what's your realized profit in the event that this goes down deeper than $290? Say we get to $285. You're now $500 or $5 in the money. All right. Both of your positions are in the money. Your expiration is still going to be January. Why? Because we don't want a very short expiration, because theta, implied volatility, all these different things will factor in. And what option premiums, in my opinion, really seem to bounce off of is the probability of the price being back at X price or not, right? And when you do that, we still want to have a moderate expiration, because if we don't, then we're going to end up with, say, we got next week's expiration. Like I said, shop moves crazy. So we went down to 280. Say we went to 280, right? We are deep in the money at this position, but we're like, you know what? It's going to go down to 240. But first of all, who cares? Because we've already realized our max profit, which in this position, as I said, is $500, because that's the difference in your strikes. $5 times 100 is $500 in option premium, right? So our max realized profit here is 500 minus the 200 we paid. That puts us at a $300 realized profit. Say this option actually fully recognized the $500 premium and you sold it at 500. So yes, you just collected the entire 500, but you only paid 2, so you're over here bonus $300 on this option trade, on this debit spread. Now, how much money could you have made earlier? Well, if you bought a $295 at $1,000, you would have realized a 50% profit right here at $500, you know, pending how theta and all that worked out with you. But if it dipped down way down here and you're still in the put by itself naked, then you're way down. You're deep in the money, $1,500, right? So you would have made some serious profit on that. But there's the catch. Could you afford to pay $1,000 for this put? Can you risk $1,000 on this trade? I don't know, can you? So here's the thing. So you got all these different scenarios, right? You got Shopify, you got Roku, you got Ford. You know, the thing is, there's a couple of rules built into debit spreads that, you know, you have to really learn from experience. And the thing is, once you understand how they work, you can start to use them and manipulate the options in your favor. So BYND, it's on a huge downtrend. The price has been positive 40 and negative 38. It's fluctuating. Why? Because the price is still on a downtrend, but today it popped back up to 84. It was 79 the other day. At 79, I was up 40 bucks. I was going to close, but the downtrend is still very, very consistent, right? So what I'm going to do, I'm going to let it lose up to $50, which would put me down to about 130 on the position total left, and I would close the position, unless I saw a heavy confirmation that it was going to keep continuing down. With that being said, BYND is becoming a relative stock I like to trade, but not so much. It's not one of my favorites. It's not like Shop. It's not like Roku. Roku's earnings is coming out this week, I believe Wednesday or Thursday. Haven't decided whether or not I want to, you know, swing on one of those earnings plays. One of our guys, like I said, he came out with a strategy called the gap strategy, where basically, it's very simple, really. I mean, you wait till the next day, basically, for the reaction of the earnings after hours. So if the earnings is pre-market or after hours, the previous trading day, you're going to be looking at huge volatility opening in the market. So if the price is going up after hours, the price is probably going to continue up during market open. If the price declines pre-market or after hours, say like Amazon did the other day, and then it did this number, but the next day it came back up here, okay? And that was Amazon. That was after hours sell-off for bad earnings, lost like $120, and then it came back up, and it was only down like 60, okay? Hopefully you guys can hear me. Shut this door. Got my helper over here. He's going to be learning this stuff in the next few years, don't you worry. Thank you, buddy. What color you want? You want red?
Yes.
Rojo, yes. Oh, dropped it. All right, so what's next? Okay, so we talked about when you would enter a debit spread. We talked about your profit, your cap gain, your realized profit once you've actually created the spread and you've actually returned fully on the spread. Now, to me, the spreads are not necessarily for long-term holds. I'm not going to hold any option likely more than 30 days. I've only ever done it twice, and the reason being was because I couldn't close the option. I would rather close it at a loss than not be able to close it at all, which goes back to what we talked about before with the SEC $5 increment, which is the ability to close an option position that's at that level. So in the event that it's 0.03, you can't sell the position. So I forgot which one it was, but it was at 0.03. Here, buddy. Let me see over here. It was at 0.03, and I couldn't close it. I don't remember what stock it was. It's in one of my videos. But out of nowhere, the price spiked up to like $4 again. It put my $3 call back in the money, and it got just high enough. I closed it, got out of it for $10, so I made a little bit of profit. But we want long expirations, okay? Always, and I'm not going back on this. This is my biggest thing since I've started trading options. What I've realized is that long expirations, all right, are the most important, to me, in my opinion, the most important thing in trading options, period. Hey, buddy. Night-night. If you don't believe this, I don't know what to tell you. So yes, if you're day trading options, scalping options, etc., scalping or day trading, scalping and day trading sort of go hand in hand. Day trading, you're expecting a move from X amount of support to X amount of resistance, and you're going to close a position. Scalping is basically the same thing. Scalping is, I'm going to get in this trade with momentum. I'm going to close it out at 10% or 5% or 30%, whatever it is, and you're done. Okay, you don't care about nothing else. You put $1,000 in, you got a 10% return, you make $100 on the day, you're done. You're out. Have a good day. Go do something else. Go walk your dog. Go drink a milkshake. Okay, for a lot of people, they do that. But for a lot of people I see, they're gambling the idea that they're going to make a big return. Everybody wants to know what the biggest mistakes of traders, why everybody loses money, and blah, 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 blah. I'll tell you one thing. It has everything to do with this right here. If you get a short expiration, 2 days, a week, even 2 weeks in some cases, you can get burned. It might be the very last day of the expiration before the price actually moves, but by that time, in my experience, and my actual doing, I've closed the position 2 or 3 days in advance to save the capital, because saving capital is what really matters. The position actually multiplied times several $1,000s. That was Shopify, my favorite. I did reap $3,500 off Shopify at one point in the last 4 months, but it also could have been $20,000, but you don't know these things. So you have to build rules, and you have to respect your rules, and you have to accept your rules, because if you don't, yeah, Bubba. Yeah, night. Now, if you don't, you will regret it. Why? Because if you don't follow your rules, it's always hindsight. If I look back at all the trades I've ever done and all the trades I've ever held, whether it's just buying shares, buying options, or etc., if you knew when to close these positions or when to wait for the position to actually move in your favor, you're still in theory gambling, because what you're doing is what you're actually still doing is waiting on hope, right? You have no price confirmation that the price would suddenly respond drastically and shoot back through the roof, closing $20 or $30 higher than what it did the day before. It doesn't happen very often. Now, when you trade big things like Shop, like Tesla, and things like that, that's when those things do potentially happen on big news swings, such as Tesla killing earnings, or Shopify beating earnings but had a bad outlook, or the great outlook but missed earnings, and we're seeing what Roku comes up with. The price action was steaming earlier this week and last week, and now it's slowly settling down. So that tells me one of two things. People ran the stock up to take profit on it from 125, 130, and or they're expecting earnings not to be as good as they think, right? So a lot of people are selling back off. Now, with that being said, again, this is why the debit spreads come in handy, because on a long expiration for Shopify, for Roku, for Tesla, these things are hundreds of dollars at minimum, even out of the money, $5 or $10 and out of the money. But if you're looking at an at-the-money expiration, you'll limit your profit, but at the same time, you increase your probability. Increasing your probability is what options is all about. You want to put the money 10 to 1 or 20 to 1 for every dollar of profit. You want only a small amount of loss, right? So with the long expiration, again, this is the key thing, and this is what I will continue to push regardless. What's up, man? What? This is mine. I got this one. I will continue to push long expirations regardless. Everybody always says, why am I losing money? Why did I lose money? Why did I lose money? Well, chances are your expiration expires tomorrow or next week, and you put $500 on the position like an idiot. I'm going to be honest with you. Okay, it's not smart trading. All right, if you want to gamble $50 or $100 every paycheck or something like that, like going to buy scratch-offs, it's the same thing. I did a Tesla scratch-offs until I went below zero or close to zero. I stopped doing it. I bought 10 $3 scratch-offs every 2 weeks simultaneously for about 4 months, okay? What was the end result? The end result was that I still kept all my money. I didn't lose anything, but it got down to $2 profit, and then I got back up to about $25 profit, and I just stopped because it wasn't working anymore. All right, and that's what happens with gambling. It's the exact same thing. You roll into a casino with 10 grand, you bet 10 grand, you're up 50 grand. What do? Do you continue with your $50,000, or do you walk out the door with your $40,000 profit? Well, a smart man would leave and probably not come back. The unintelligent man and or woman would stay and continue to play with their $50,000 and probably walk away with $3,000 in the end or none. And it does happen. That's gambling. All right? It's frowned upon. So, with options, could you buy 10 out of the money calls on earnings or 10 out of the money calls on big news or 10 out of the money puts on big news or earnings? Yes, you absolutely can, but that's your choice, 100% your money. If that's what you want to do and it works out for you, great, but eventually the steam will run out. All right, I don't know why your kid's obsessed with messing with exactly what you're doing at the time, but they love us. So, fish hook trader, all right? What is the fish hook trader? All right, the fish hook trader is exactly what it means. It creates a fish hook pattern in a chart, okay? And that is a great example of this, all right? Because this sucker sold out from 240s, I think it was 240 or 250, and it got down here to 172. One day, it was at 189, and the last time I looked at it, it was at 195-ish, I think. So from here to here, that's a $20 gain right away, okay? And with that being said, we've just made a huge return if we would have bought an option for $195 a month out. This happened in like 2 days. You would have easily made this money back very quickly, okay? But that is the fish hook, all right? Now, when do you buy on the fish hook? When do you sell? Well, we never want to lose money, so chances are, when it did, and this thing swung exactly like I projected it, but I didn't play it because I didn't have any funds tied up to it. And I most definitely wasn't going to spend $200 a share or $180 a share for it to go back down, okay? Because this could potentially happen, all right? The sell-off could continue after a slight volume, and then the sell-off could continue. Or it'll continue to swing up a little bit,